Do you think bonds will reduce volatility? Think again. Not so, by Mike Adams. From 1945 through 1980, bonds experienced a crushing bear market from 1960 through 1980. Many of the highest quality bonds sold at a loss of 50% or more. Shorter term bonds could not keep up with inflation, losing up to 70% of purchasing power. The bear market in bonds lasted over 36 years. Most financial plans and financial advisors count on bond returns using data from the 1980s. That has been a long 40 plus year bull market. I have not seen any plan that features devastating losses in fixed income. We believe the probability of another crushing bear market in bonds may be in the making. At any given time, bond prices are determined by three things. One, credit quality, two, inflation, and three, geopolitical situations. We believe bonds could be on the verge of all three. Credit quality. The United States government debt stands at $37 trillion. That is a problem. Credit quality of debt in a country is not that different from the credit scores an individual gets from the credit agencies. It is a function of income and debt. For a country, the income is GDP. United States debt for the last century and beginning of this century achieved the highest rating possible, AAA, by all three rating agencies. As of August 2023, our debt was rated AA plus, with both Fitch and Standard and Poor's and AAA by Moody's. Now Moody's has cut the rating. Credit quality has cut the rating. Credit quality has begun to decline. But the United States is not alone in that. The world is awash in debt. Six of the G7 nations now have government debt greater than 100% of GDP. Those countries are Japan, 255%, Italy, 144%, the United States, 123%, France, 110%, Canada, 106%, and the UK at 104%. Worldwide debt is $307 trillion for a $100 trillion world GDP. Debt stands at 300% of GDP. There are 54 nations that are on the verge of a financial crisis. 22 of those nations have either already defaulted on their debt or are on the razor's edge of default. Credit quality is on the decline worldwide, and that includes the United States. Based on credit quality alone, bonds will probably experience a bear market. Inflation. Bond prices decline as interest rates increase. Bond buyers expect returns that will meet or slightly beat inflation over the long term. So as inflation picks up and the coupon interest rates on new bonds increase and existing bond prices decline. There are only 5 ways out of excessive debt, and the world has excessive debt. The world can grow the economies faster and pay down the debt. The world nations can raise taxes, hold spending constant, and use the higher taxes to pay down debt. Reduce spending on education, infrastructure, and the social net, and use the savings to pay down debt. That means cutting Social Security, healthcare, unemployment benefits, food stamps, agricultural subsidies, and more. Increase inflation so there is more currency to pay down the debt owed, or default on interest payments and reduce or delete principal payments. The two highest probabilities are default and inflation. The chance of tripling GDP in the next few years is very unlikely. Some countries will still try to raise some taxes, and some will try to reduce spending. Countries with the highest level of debt will probably default in the same way Greece defaulted 10 years ago. Countries with manageable debt will probably try to inflate their way out of printing more money to cover debt. No. Countries with manageable debt will probably try to inflate their way out by printing more money to cover debt refinances, which will be required. In the United States, the Fed pushed up Fed funds, short-term rates to deal with demand, pull inflation, and they were successful. However, we now face a different kind of inflation. America is facing cost push inflation. Demand pull can be stifled by raising interest rates. Cost push inflation, driven by wage increases and material cost, is more difficult. The cure for cost push we experienced in the 1970s, stagflation. Stagflation is inflation with the recession at the same time. That does not help bonds. The impact on short-term bonds will probably be even more devastating. The dollar from 1960 to 1980 lost 70% of its purchasing power. What that meant was, on average, what cost $1 to buy in 1960 cost $3 to buy in 1980. In 1960, a first-class stamp was 4 cents, a Coke was 10 cents, a dozen eggs 57 cents, and a gallon of milk was 49 cents. By 1980, the first class stamp was 15 cents, a Coke was 35 cents, a dozen eggs was 91 cents, and a gallon of milk was $2.16. Those portfolios sitting in cash had lost 70%. Short-term bonds and notes track the value of the dollar. From 1960 to 1980, the dollar lost 70% of its purchasing power. Think eggs at $6 per dozen are expensive now. If we experience an inflation like the 1970s, eggs will be cheap at $28 per dozen. Milk could rise from $4.15 a gallon to over $15. A loaf of white sandwich bread could increase from $3.12 to over $14. Those prices seem almost unmanageable. But if the stagflation of the 1966 to 1980 period is an indicator, they are realistic. Think of how prices soared in 2021 and 2022 with a short bout of inflation. The inflation stagflation time of 1964 to 1980 was a period of 16 years. Think of what that does for portfolios or investors who rely on fixed income or fixed annuities. For short-term bonds, a similar situation will probably result in a devastating loss of purchasing power and quality of life. Inflation, even with the latest figures in the United States, is again on the increase. The impact of tariffs will probably increase inflation and reduce trade. Based on inflation alone, bonds will probably experience a bear market. Geopolitical. It seems like the United States is going to experience all three factors that are negative for bonds. President Trump has shifted from aligning with our traditional allies to connecting with Russia and Hungary. He has initiated tariffs and first implemented them on our two closest neighbors, Mexico and Canada. The impact on tariffs on both those countries will probably hammer their economies. For the 500 companies in the S&P 500, fully 41% of their revenues are generated overseas. Those revenues are generated in countries on which our president has imposed tariffs. Their response is probably to react by implementing tariffs on a good portion of the $7 trillion of revenues the largest American companies generated overseas. Many of our former closest allies are negotiating free trade agreements with other allies and excluding the United States. That will place the United States at a significant disadvantage for those revenues that were generated overseas. Bonds are presented to investors as stability and reduction of volatility in portfolios and financial plans. That seems short-sighted, ignores history, and sets the stage for significant losses. Annuities are even worse.